Well, let me begin by introducing Ron. Ron is known to me because of Gordon Menzies, who came to visit us. And Gordon is a colleague of Ron's, or I rather mean Ron as a colleague of Gordon's, at the University of Technology, Sydney. And while Gordon was here, he said that Ron would be visiting the UK and would very much like to come and spend some time attached here, which he is doing a period of a fortnight here in Oxford. And we saw Ron for the first time yesterday. What I hadn't realised was that my connections with Ron go back quite a long way. He was a graduate of Monash, did graduate work in finance way back in the early days of doing finance as graduate work. And then, I think I'm right in saying, then went into the private sector and then went to the ANU, or was it straight from...
No, I don't know if Macquarie University is the private
That's
sector.
right.
I went there for 3 years.
And then to the ANU, where Jenny is permanently located and where I go and visit a lot. And he became, I think, head of department in finance and ran the honours programme in finance at ANU, what seems like millions of years ago now. And as he said to me a minute ago, was sufficiently old then, although it's so many years ago, to have been made an emeritus professor when he left. And has been such, it was not, as he said to me a minute ago, a prediction that soon he'd die, because all emeritus professors seem to die quite fast. Then went into the private sector and gained much of the knowledge that this exposé today is going to build upon. But for the last 10 years has been back in academic work at the University of Technology, Sydney, with my colleague Gordon Menzies. But you'll see that this is an unusual person sitting next to me. He is not a macroeconomist.
Now you've been talking to my wife.
Not a macroeconomist, as most of us who've been doing work in the Max Watson Peffham group are. He's a finance person, and thus particularly well qualified to talk to us about the finance industry, both from his academic work and from his time in the private sector. So thanks for coming to talk to us, Ron.
Thanks, David. Yeah, I think this may be a bit different. Just reflecting, Gordon, for the last 10 years, I've run a centre at the UTS, been the Centre for the Study of Capital Market Dysfunctionality, and of which there's one at LSE and used to be one at Toulouse. And Gordon's been Deputy Director of that centre for pretty well all of that time. And indeed, I saw that the problems we dealt with were more to do with macroeconomics than finance people and Jordan and I did a fair bit of work looking at the effect of mispricing in capital markets has on the economy, using working with a problem called Peter Dixon on using general equilibrium models, which has led to Peter putting a finance sector into such a model, which is a huge weakness of those models, that they're just pass-throughs in terms of the financial sector. So thank you. I want to start. Well, I was going to start by saying that I've actually been fortunate or unfortunate to see this industry from lots of different angles as an academic, as a fund manager, but also when I left universities, I didn't want to do anything which was too risky, so I went into consulting, advising, working for an actuarial consulting firm, Towers Perrin, on advising big pension funds on how to invest their money, including UniSuper. I was the advisor at the university scheme for a few years. So that was an interesting period, because when you had people with billions of dollars to invest, the funds managers were quite wanted to talk to you, obviously, and try to tell you how they perceived, how they manage money, or at least their marketing story, if not their true story. So it has been interesting. I want to start with a story which you may have heard by Warren Buffett sent out several years ago. It's a story about a family that owned corporate America. and they own corporate America. I mean, some junior people had 0.1% of corporate America, and maybe older people had 3%. But they held it all the organisations they held in a fixed proportion. So it was a bit like you call it today. They were just index funds. They held it as an index fund, and along came these guys who said, well, you know, you can do a lot better than. And they made money. The corporate America grew, and their value of their holdings grew. But they said, well, you can do better than that, because you can buy and sell and trade between these organisations that you own, and you can make more money because you can trade into the ones that are going to do well and now the ones that are going to do badly, and so they said that sounds, or someone said that sounds good, so yeah, let's do that. And a few years later they came back and they found that the return they got was basically the return on the market less the amount of money they paid these guys for trading, the brokers, right? And they said, well, you know, that's not working out so well. But then another group came along and said, well, look, you probably need advice on what you trade, what portfolios you hold. And so they said, well, that sounds good. We'll employ you guys as well. And they got this advice. These people actually kind of managed their portfolios for them, putting transactions through the guys who did the trading. And they came back a few years later and they said, well, we kind of got the return on the corporate Americas supplied us, but less the amount we're paying the brokers, and now these people are advising us, the fund managers. Okay. And that's not working out too well, right? We're doing worse than what we were doing previously. And then the guys came along and said, well, basically the idea's okay, but you're picking the wrong people to advise you on what the portfolios you should hold. And I said, oh, okay, we'll employ you guys, and you can tell us who are the good guys that manage the portfolios and who are the bad guys. And a few years later, they came back again and they said, oh, no, we got the return, but that's the amount we paid to the brokers, and then to the fund managers, and then to the consultants or the advisors, the financial planners, if you like, who told us who to invest the money by. And the story actually goes on, because it goes on to hedge funds now and to everything else. But what we do is, of course, we have all these service providers, these advisors, actually clicking the ticket along the way and taking a fee and maybe to no useful purpose. And that's kind of what my talk's going to be about in terms of. I said I think there's some questions to ask in terms of, if you thought. You would think that people are not actually being all that rational in terms of using the services of these people, but that maybe you can tell me why we do it. We've certainly looked at that to a certain extent. Anyway, we're just going to look at one group of these people in particular today, and that's what we call the funds managers, or what I call the asset managers, right? People thought I might be talking about the IMF or something, and belittling them if I use the word funds. So these are the guys who take our money and they invest it on our behalf, right? So we give them the money, they invest it in portfolios, we take the risks, we give them a fee, typically based upon the amount of assets that they manage, maybe a performance fee as well. And this is not a small industry, as we see. I mean, it's $71.4 million, trillion managed worldwide by these guys. They make profits of about 102 million. Not a bad profit margin, 37%. And one of the bad things, I guess, from because what I'm talking about really are active passive managers, people who try and outperform the market rather than an index fund, which just gives you the market return. I mean, there's been a swing, particularly in the last little while. There's been a swing for many, many years, but it's growing in acceleration, if you like, towards moving money out of active management into passive management, particularly with the growth of instruments like exchange-traded funds, which makes these investments quite small. So these are people who are becoming a big share of a lot of the markets. Last year, I was seeing that. The swing in America was about 300 million or something out of active management money, and $500 million into passive management. So that in 2016. So this is a trend that continues. Although, if you think of it, I can touch upon that. Passive management's not really doing anything much for the economy either. I mean, there is a social role, right, in here. I mean, these people set prices. These people help us set prices, and the prices, in fact, affect the distribution of capital. And although most of their trading is in the secondary markets, it does affect fundraising and supposedly contributes to a better allocation of capital, scarce capital, and therefore better economic growth. But they don't really do much in that area either, as we'll see. Okay, so that's what they do. The way the game's been played, and this wasn't always the way, these people normally manage against a benchmark. So if you're managing, say, as it's got there, a large UK equity portfolio, you're benchmarked against the FTSE 100 or some similar index, and what you've got to do is take positions, or which I like to call bets, against that. So you've got to overweight some stocks, underweight other stocks, hoping that the ones you overweight are the better performance and underweight, and you outperform the index, right? But what we've created, and this is nothing here, Bill Sharp pointed this out a long time ago, is a zero-sum game. I mean, on average, across all the money invested in these stocks, there is an average return, and if active managers happen to compose the whole market, then as a group they couldn't outperform, and that's kind of the game that we've produced, and so the only way that somebody can win in this game is if somebody else loses, and hence we've got to find people to lose. To be a winner. It's as I've said before, I mean, it's not an industry where you want to get rid of bad players if you're a good player, right? Because if you get rid of all the poor performers, which you would do in most industries, like drive out the weaker people. With this, if you drive out all the weaker people, then there's no one to beat. And so it may well be that it's worth paying people who know nothing about what they're doing to actually manage money rather than anything else. Isn't it? No. I do. Well, no, we'll look briefly to talk about it. I mean, how do these people go? This is this back to I guess about the 60s. We've actually done a lot of work on performance of these people, and their performance comes out not being all that good. I mean, as a group, it's a generalisation. They tend to about get the index return. But after you take off the fees you pay them, they in fact, as a group, underperform. So that's kind of the state of that's the state of things in terms of the studies that have been done effectively worldwide. Even more importantly, there's very little persistence in performance. I mean, there are people who outperform, right? There's got to be people who outperform. So. If in fact there were people who consistently outperformed, then it would be, I mean, you just identify them and you have a good fund manager. But the fact is that through time there's very little persistence in performance. It makes it very, very difficult to in fact choose fund managers to give you outperformance. I mean, I've always described it when I was back in consulting as trying to hit a small and fast moving target, is trying to in fact select managers to in fact give you outperformance. And then there's this quote from the FT on managers. I mean, it's a sad state. This is maybe about a year or so ago. 83% of managers underperform. Some of them quite badly, that they disappear off the face of the earth. Excuse me. Excuse me. And as they say, if it was any other industry, then in fact, there'd be hell to play in terms of it. But we seem to, in fact, put up with this state of affairs in the funds management in the funds management industry. So there's really two things that fund managers do. They kind of could make money for their clients, that's possible, and as we've seen, the evidence on that is not very promising in terms that as a industry they do that. The second thing they do is what I mentioned before. They do obviously provide quite a social function in terms that they help set prices in markets. And I guess one of the three areas, main areas in finance is the efficient market theory, which is that markets are informationally efficient, that information is correctly impounded, on average correctly impounded in prices. And that's really a precondition for allocative efficiency. I mean, you need efficiency in pricing in capital markets to get the correct allocation of capital, and that is useful because, in fact, if you allocate your capital to good projects and avoid bad projects, then you get more economic growth, you get a bigger pie, and indeed there's the potential for everybody to be better off. But there's been a number of studies of those, and there's some mentioned here. I mean, the person who does great work in this area is Phil Pond from NYU, who's done a lot of. And as he points out there, we've had we spend a lot of money on funds management, as you see. I mean, there's a lot of it going on, and there's a lot of money paid to the people working in the industry. Information has become more readily available over time, cheaper to access, as we know, and big data and all of that. But there's absolutely no sign that the markets have become more efficient in an information sense. And Melchior, who's never liked active management, I guess, it says, and points out here that between 1980 and 2010, in the US, the amount of money we spent on active management has increased 141 times, the big increase, without any sign of any improvement in pricing in markets, and particularly in equity markets. I guess I must premise this, that if this is talking about anything, it's more talking about pricing in equity markets than in other asset markets. So it doesn't seem that these people actually serve any useful purpose. Well, put it this way: they don't do the job that they are attempting to do well. Anyway, I mean, it would just think of a world where we had no active management, and what would pricing be like in that? Just think of a world where we had 100% index funds, and company A came up with a new profit announcement right today. Now, what would happen? Absolutely nothing. Index funds are only wanting to max the weights of the stocks in the market. They're not interested in information. So, if we didn't have any active management, then indeed we could not have. I mean, what pricing would be just chaotic in terms of these markets because there'd be nobody trading. I mean, I'm saying that's a world which we will never quite reach. Yes, sorry.
But surely, in order to keep the index right, you've got to sell out at the top and buy at the bottom by definition. I mean, if you're going to keep to the index, you've got to trade.
An index fund doesn't have to trade if it fully replicates the index. In other words, that if the stock goes up in value, it's holding automatically adjusts to the new index weight, and so you don't really have to trade with full replication. I mean, a lot of index funds statistically try and match the index without holding all the stocks, and they do have to trade. And you are right; they have to reinvest dividends, and so they do have to trade to reinvest dividends and things such as that. But they don't have to do it. They don't have to do a lot of trading. A good index fund would run for a cost of about 20 basis points a year. I mean, in terms of the transactions cost and everything associated with it. So, but I mean, that was the initial. What I'm saying is the initial kind. How can markets be efficient if everybody believes they're efficient? Because if they were efficient, you wouldn't have active management. And then obviously they couldn't be efficient because you need active management to make it efficient. So that was kind of the conundrum which was discussed back in the 70s and 80s in terms of when the efficient market hypothesis first became well, probably the 70s, really, when it first became popular. Just going back, this is not quite, as you may have seen this. This again comes from Philip Holm. This is kind of looking at salaries in the finance industry more generally. What he's done is, you can see that really up to the early 80s, people in the finance industry doing senior jobs got about the same as people in other industries. And then it took off. This is adjusting for factors which you would affect, you would think, earnings like education, experience, location, all that. So this is an attempt to, in fact, isolate other factors such as superior people and things, and work out what is just the difference between doing the same job in one industry versus the other industry. And it really is just it shows about a 20% premium. You might think it could have gone away post the GFC, but it really hasn't. It really hasn't gone away. I mean, the thing that surprises me about this one is we often look at finance firms and look at what returns to shareholders are to see how profitable these industries are. You really want to look at how much the senior management takes along the way. At places like Goldman Sachs, they take about 70 cents in every dollar of income goes into the pocket of senior management. Right? Now, I mean, so really, if you want to see how profitable these financial institutions are, you should look at the returns to shareholders, and you should look at the premium which is being taken off by the senior management to see just really how terribly profitable these organisations are. And if you look at the banks, even I know talking yesterday about how the poor returns on the banks. I mean, have a look at what the senior executives of the bank are in fact taking. You may get a different impression of how profitable those organisations are. Anyway, we have this situation which I want to address. I mean, we have an area where people are very, very well paid, but they don't seem to be actually doing anything that's useful to the economy or to their clients, right? And you would think that's not a stable situation, but it has been stable for a long, long time. I mean, as I say to my students, I mean, if you have no confidence in your ability, go and become a fund manager. Because of the noise in the system, particularly in equities, again, because of the volatility in the system, as Bill Sharp showed, it's 40 years before you can judge whether anybody is good or bad at doing the job. Now, that should see you through, right? If you start in your early 20s, you're going to be in your 60s before people actually work out, no, you're not really good at what you do, are you? And you might say, well, yeah, that's pretty true, and go off and retire, right? Because you've actually accumulated quite a few dollars on the way through. So it's a great industry to work in. I mean, it's not quite the same in investment banking. Investment banking, they can probably tell in a week whether you're any good at what you do or not. And there is a bit of a premium. But fund managers are not badly paid relative to other people in the finance industry. And to my mind, it's ridiculous, I think. Ask me why I've set up 3 funds management firms during my life, worked for several others, and advised many, many others. And what am I doing here, you might ask? Well, the only thing I can say is I find it very boring. And I'm quite happy to pay a heavy premium to be less bored, I guess. Something along there. Now, every year I start out with a colleague, and we say we're going to write an exposé, if you like, or really an economic analysis of fund management as an industry, and every year we don't do it. Partly because I'm reasonably lazy, but he's a lot lazier than I am, which is I need to get a better co-author on that score. But also because it's very hard to put all the bits and pieces together. A bit like listening to Charles yesterday. I mean, there's so many balls in the air at any one time. So how do you write it down in any? I mean, the real trick is to put it all together and actually make a good story of it. It seems to be too complicated. But there's a few things about the industry which I think make it a bit unique. I've mentioned it many times, but the volatility or the performance is so driven by noise that it's an industry where it's almost impossible to judge quality. And obviously, if you're selling a service or an asset where you can't judge quality, then in fact you do have the markets break down, right? I mean, if you can't tell who's better, and that gets back to 40 years of working out who's good and who's bad, then the whole pricing mechanism in this, in fact, has weird consequences. Second thing is, and I think this applies to capital markets and institutions more generally. Money is very sticky. It's very hard to get a client to take their money away. Really, it's not, it's the new money goes to the people who have been performing well recently, right? So, but if you've got, say, 50 billion there and you've been trundling along doing not a hopeless job but just a slightly hopeless job, then most of those people will stay with you, and so it's well, the other part of it, which I would have got, I'll mention now, is, as I also say to my students, just because you're no good at it is not an excuse for not doing it. Okay, let me give you an example. This is getting back to volatility. We all have our ability is really measured, you might say, by our alpha. That is our inherent. If we did this for 1,000 years, it's kind of the performance relative to the market that we achieved, right? And as I said, that's going to be some of us are going to, because the way it's a zero-sum game, some of us are going to have a negative alpha and some a positive alpha. But just assume that I have a negative alpha minus 1.5%. That means that I will underperform the index by minus 1.5% per year. Now, normally we measure performance of these people over periods of something like 3 to 5 years. That's kind of the industry. If you come in, people won't normally throw much money your way if you haven't got a lot of history until you've got about 3 years of performance. But if you outperform by 2% per annum over that period, they'll throw a lot of money your way. Now, given if I have an alpha of minus 1.5%, my probability of reaching that benchmark and actually being able to build up a business is about 1 in 3. Okay, now that's not bad. I'm pretty incompetent at what I'm doing, but every time I play this game, I've got a 1 in 3 chance of actually hitting pay dirt and actually building up a business. Now, I don't know many other areas of endeavour where those things work out. So we do see here, people go and do it. They see that they're not going to be able to get there, so they close up shop, go and lie on a beach for a few months, come back, put up their shingle with a different name and start the game again. I know they're all independent events, so you can't say if you do it 3 times you've got a 100% chance it'll happen. But your chances are pretty good eventually of, in fact, being able to grow quite a profitable operation. By the way, what is obvious, you can't reverse engineer. Just because somebody does well, you can't presume they're good, right? I mean, a lot of people out there running funds management firms which are making lots of money are not good at what they're doing. But that won't mean they won't continue to do it for a long, long time into the future. We'll look into that in a sec. So, it's also a good. It's the financial services industry more generally in terms of fundamentals. Is I think if I was going to say, well, I'm going to finish my studies and I'm going to become an agent, and most of us do, right? There's only one industry to ever think of being an agent in, and that's the financial services industry. I don't know, did anybody see David Hare's play about the global financial crisis? No. Okay, well, I saw it at the National Theatre here. It was quite good. It had a lot of real world people in it. But one of the things when it was about agency costs was that if I work in an ice cream factory, I'm going to maybe eat a lot of ice cream, but I'm going to be saturated eventually, right? And just thinking having one more ice cream and you'd go and run 100 miles, right? But what is one thing you can trade in where you don't have saturation? And it's money, right? So the basic commodity is money. It's much better to be an agent in an area where, in fact, money is the commodity you're dealing with rather than any other commodity for us now. The other thing about the financial services industry, and this varies a little bit, I tend to be jaundiced by looking at this in an Australian context, is if I'm going to be an agent, I'd like to be an agent in an area where the principal doesn't give a damn about what I'm doing. Okay. Now, an extreme example in Australia where we have compulsory super from when you start after paying when you start work, say at 20, and you can't touch it when you're 60. People in Australia will find that they don't even become interested in their super to when they're in about 50 or the early 50s, right? And it doesn't make any sense. I can't do much about it. What I'm going to get out of it so far ahead, why waste my time and stress about something which I have so little control? Now, so if I'm managing these people's money, these are agents who I can really do pretty well anything for, and they're not in fact there's going to be no payback for me for doing things badly. But that's reasonably true. That's not as true in other situations, but it's more generally true in the financial services industry that principals are less interested in what their agents are doing than in lots of other ones. If someone like a mechanic servicing my car, I'd be much more interested, at least immediately, in terms of what they're doing than in fact what fund managers are. So it's a great industry to be an agent in. I mean, and that's why we see, the agents in this area, the service providers in India, just grow like topsy. This mushroom. There seems no end to it. But that's getting back to Buffett's parable. As I say, a fund manager is somebody who manages your money for you until there's none left. But then sack you. So, no, that's kind of some background. What I want to do is quickly go through a bit of research we've done, because we have done some research. It's not all just aimless whatever, which has some implications for this, provide some insight into it. What I like most is we tried to model the funds management industry in terms of how it behaves, given the incentives which it has. Okay, and this is a bit different for me. It's not good work. I mean, I'm an empiricist, so when I try to do anything which involves any modelling, it's I have to find people to help. Now, starting the game, this is repetitious, right? People have benchmarks these days, and people take bets about benchmarks, and we're going to look at this particular example of this. So why don't I move on, because that's pretty repetitious. One thing that will come up time and time again in this is this idea of active management. Kremers and Pedagogski have quite a well-referenced article on the relationship between how active managers are and what their performance is, and this is how we measure. This is how we measure active performance. Let's assume that a stock is 1% of the index, and in my portfolio, have 2% of my portfolio in it. Right, so I've got a weighting at 2. The index weighting is 1. So I've overweighted that by 1%. Obviously, so what this does is it adds up all the over and under weightings, obviously in terms of absolute, everything positive. That'll add up, because if you just added them up, they've got to offset each other. The over and under weightings have to equal. So you add them up and divide by 2, and that's a measure of overweighting. Now, if you held the index, this score would be 0. If you held no stocks in the index, it would be 100. Right? So it's a measure of how far you depart from the index. And they found that the more active managers tend to do better than the less active managers, and there's good reason for that, and we'll see that shortly. But this measure I use a fair bit in these studies. Okay, well we use some data, US data, because that's the only data we can get reasonable insight. We need the evidence on. We need the portfolio holdings of the managers, and this is the easiest way of getting it. We know academics don't do anything hard. If I had to go out and collect this data, that would be too difficult. So I need to get it electronically, and so that's what we have. Now, this article I like this one. How to make clients sad, where sad is the initials for strategic alpha dilution. But what we're really assuming is we have an active manager, and if he was doing what he thinks the best he could do, he would have a certain active portfolio. Okay, so that's one possible. Put all his money in what he thinks are his best ideas, if you like, his best portfolio. Alternatively, another option that this active manager would do would be to invest in the index. Right? Put all his money in an index fund, although he's supposed to be active. What we're looking at is, if I was a manager trying to maximise the value of my firm, how much of my portfolio, how much of the money I manage would I put in my active portfolio, and how much would I put in the index? Right? That's my decision variable. How much I put in the active portfolio, how much I put in the index. My aim being to maximise the value of my firm. Okay, which kind of makes sense. So that's why it's strategic alpha dilution. The less I put in my active portfolio, the more I'm diluting my active bet. So, and what we did, because this was not tractable in terms of we actually solved this numerically. But to give you some background on this, this comes from mainly from Russell's consulting. But if I can explain that, look at if you take the top one there, and let me see, that's the returns of. That's a group of small managers, and what return do they get in their first year, second year, third? These are new, third and fourth year. You can see that their returns got worse reasonably consistently and rapidly. But what is more interesting is what happened to the risks they took. What was the volatility portfolio? Their risks they took went down. And this third one is their stock holdings. How many stocks did they hold in the portfolio? You can see that went up. But what this shows is, okay, if you think of the game I said before, I've got some money, maybe. I mean, most of the funds I've set up have got some benefactor to give us 20 million, 10 million, 20 million to start getting a performance record. What you do is you roll the dice and take big bets. There's no point doing anything else, right? You got nothing to lose, and you got everything to gain. And and you're only going to actually hit pay dirt if you get a good outcome. So you roll the dice. These are what these guys are doing. When you haven't got a business, you actually effectively put a lot of money into your active portfolio. You don't dilute it in terms. When you get more and more money, the incentives are to dilute it. That was the US equity managers. The second one over here is overseas global managers. You can see that's on size. The small ones do very well, and the big ones do quite badly. Okay, but that's kind of some of the empirical facts which we wanted our model to produce, to be consistent with those. Now, how does the game play? This simply, as I said, the objective is to maximise the value of the firm, or effectively maximise the value of our fee income. As I said, the decision rule is how much I put in the active portfolio and how much I put into the index fund. Okay, and the game is played this way. If you, little small t there, that is the interval over which I'm judged, right? And if I hit a performance above the upper threshold, then I get money. If I do below the lower threshold, then I lose money. And of course, there's a big range here where effectively life goes on, and my current clients stay with me, etc. Right? And that's kind of the now. How does that? If that's the world we live in, then how do I behave? Well, G. Oh, if I go back to that, G is the payoff I get if things work out well, and minus C is what I lose if things do badly. But G and C are not. If you start off, when I start with hardly any money, there's nothing to lose. C is very, very small. I can only lose the client I have, so there's not much downside. G is potentially very large. So when I start off, G is very high relative to C. As I get lots of clients, C becomes big. And and it grows up towards G. In fact, there are other factors going on. By the way, the other factor going on is that my alpha, my ability to add value, is a function of how much money I manage. As the amount of money I manage gets bigger, it's more difficult for me to produce performance. A, because I'm spreading my ideas across a much bigger amount of capital invested. But secondly, I impact on markets and give back a lot of what I'm getting. So my alpha naturally falls as I get large, and of course my payoff becomes less attractive as it gets large. So what happens here? This is 0 to 1. This is naught means where I put all my money in an index fund, and 1 is where I put all my money in my active portfolio. So that's a measure of how much I'm putting towards each of them. Now, in this one, C, you can see across the bottom, 0, it's all just a numeraire as far as that's concerned, 0 to 0.1, and you can see I've plotted it for values of how managers perform, where G goes from 0.05 up to 0.7. In other words, the top one up there is where the payoffs are very large relative to the potential costs. And in that world, I will make big bets. They will get slightly smaller as C goes up, and obviously the ratio comes down, but they're big bets. If you take the second from the bottom one with the triangles there, that's where G equals 0.1, and you can see it hits. And I stopped taking bets about when C is 0.09. Okay, that's a bit below 1. In fact, I become an index fund. Well, logically, if I was risk neutral, I would become an index fund when the payoffs equal the costs. Expected payoffs equals costs. But because I'm risk adverse, I in fact become an index fund a bit before that. So you can see, though, therefore, a young firm with a high G and a low C will take big bets, but as it grows, it will become more like an index fund. And eventually, it'll reach a point where the best way of managing your firm is to run it as an index fund, which we call closet indexing. Now, let's look at... But in all of that, I've assumed that the manager has no skill. His alpha is 0. He's not bad, or it's not. He brings nothing to the table. In the next one, I look at what happens when... this is... Across the bottom now, I have alpha from -3% to +3%. And then I have different values of G, where... And here C is assumed to be 0.05. So the sum running along the bottom here, right? Well, take the... It would be easier if I was pointing here. But let's take the crosses there. The crosses are there. G equals 0.3 and C equals 0.05. So the ratio of G to C is 6. There's quite a big... Now you can see there, we have a manager who has an alpha of -0.03, but he still would be taking sizable active bets because the payoffs are so large. In other words, that's why there should be no impediment to this industry, at least, to go into it if you're no good, because your chances of, in fact, running a reasonable getting a reasonable business are not insignificant, and you would be your incentives are to play the game. Okay, it's obvious that if you look as managers become better, that the size of their bet size goes up, as you would expect. But the more interesting thing is that the people who are not good at doing it, in fact are worse than average, in fact will still in fact be out there playing the game.
I can't quite understand why someone with an alpha of 0 or less than 0 still can do well. What does can do well mean? see
Well-
that the returns are probability distribution, and that sometimes you do well, but let's suppose it's normal, then if your alpha's less than 0, on average you do less than the index.
Well, if people could identify what your alpha is, then your true alpha is, then in fact, obviously you wouldn't do well, because they would say, well, you're worse than average, and I'm not going to give. But the problem is the fact that what they see is the performance which is generated, and because the performances they're so volatile.
Yeah.
It's easier for a person who has an inherent negative alpha to actually display quite a positive performance for a reasonably long period of time, and hence suck people in to thinking that they are competent. It's the story I said before.
But on average, someone who is alpha less than 0 will just, on average, let's have a whole heap of them. On average, those people will do less well, and what's really going on is that the C is below 0, so that it's quite hard to get people to quit. So that even when you do less well than average, people can't be bothered quitting. Is that what's going on?
Well, what goes on here is that I haven't touched the end game. What happens here is that you start off small, where the incentives, the potential gains are very high, the potential losses. You build up a nice business, and then it becomes more symmetric. The gains and costs become similar. And what do? Well, what you do is you become an index fund, right? If you become an index fund, you stay within the range. You stay within the range.
That's clear. But the initial sentence that you said isn't clear.
Okay.
The potential gains are very high, you said, for someone who has an alpha less than 0.
Yeah.
I don't understand the meaning of that sentence.
Well, all it means is that somebody, in fact, can appear to do well, even if they're relatively not skilled at the job, just because of luck.
Yeah, but on average, 100 of those people, less than 50 of them will appear to do well.
But you can play the game again.
Well, I thought that was going to say that there's a quit and start again strategy built into this model. Okay, I hadn't understood that.
Timing. The clients the clients are sticky. Let's assume I'm a non-sticky client, a very alert client, and I'm looking at the returns. Typically, am I going to say you did badly last week, or last 6 months, or last year, or last 2 years?
No.
So it's presumably what you're saying is that there's a lag as poor performance comes through as well. That's part of the quit and start again. It takes time, even if you're not doing well, it takes time for people to find out.
Sure.
So that's
But he's also that last answer was critical. There's a non-linearity, because if you do badly, you just quit and start again.
Yes.
And the multiplied probability of quit and start again, even if your alpha's less than 0 and 100 of them, they're going to get heaps higher than 50% returns, because all the bad ones quit and start again.
But that's over years, not over weeks.
Yeah.
And so you've got quite a few differences of assessment and of opportunity for starting again. Do you know what I mean? It's quite important to know whether you're talking several weeks or several years.
Well, this is not it's years more than weeks. What you do in this game, by the way, is when you don't wait 3 years and say, no, I didn't get there. I mean, you will observe that. Maybe after 12 months you say, my performance has been so bad in the first 12 months, the probabilities are very high, I can't reach the benchmark after, so I'll quit then and go back and play the game in 6 months from now or something. I mean, so you do have the advantage of being able to choose when you would. It's kind of an abandonment option, really, isn't it? And you can choose when you do it, and then foreshorten the game to a certain extent.
Let's say clients are choosing over the last 3 years of performance.
Yeah.
This game, I think I've understood it, allows you to throw away bad draws. and statistically, if you're able to throw away bad draws and start again to create a 3-year moving average, throwing away bad draws will pull the expected outcome above the proper mean of the system. I think that's what I'm being told.
Well, yeah, you can. Yeah, effectively you can do that. Effectively you can do that. I mean, that's what you do. You have to play the game. So there are kind of lots of services out there that measure fund performance and stuff such as that. You don't go into them. When you're playing this game, you don't actually put your name up and go into those services till when you have a much higher probability of in fact getting a good outcome.
Yeah.
Because because that will be a stain on you, and that will go on to the next round. So you've got to keep out of the performance measurement stakes until that is. We did the opposite. We went in them because we got fantastic performance for 3 months when I set up GMO, and then we had terribly bad performance. And the only good thing I ever did in GMO was to convince the people who maintain these systems to drop us out after because of some story I made up. And they're very. I mean, it had to be a good story because they're very. When you come to them and ask to be dropped out, they're not stupid. They know that there's some reason why you might want to be dropped out, and because that would have actually killed us for not only for that time, but up probably 4 or 5 years out. So dropping out and being able to start the game again.
You had to rename yourself and
we had to say
repaint the building.
Something went wrong and we did everything. We did something wrong and we found out our errors or something. It was a bit more complicated than that, and so therefore it wasn't really a good indication of us. But anyway,
just clients.
But the one firm I set up actually, and I mean, I've got to say this, outperformed the index by 13% in its first year. I mean. And it was the fastest growing fund ever in Australia. Anyhow. It went from 20 million to 6 billion in 3.5 years, and that was pretty big in the Australian market. 6 billion. You make a lot of money on a fund manager who's got 6 billion now. And I then told the person in front of that 13% is a bit of a worry, right? Because you might say if we were really good, we might be getting 3, that would be really good. So. That suggests that if we got 10 above, it would be equally as likely that we're going to get 7 below. And anyway, but I got bored and left that one too. Before they don't exist anymore. I like their lead fund managers, and then they go out of existence. That's kind of I feel good about that. Anyway, this is just a little story. I mean, if we look at someone who is good. And when they're very small, there's actual numbers behind these, but they will invest a lot. But somebody who's bad and very, very small will still, as we said, play the game and put a fair bit up. But as the people grow, 2 things are going to happen. The ratio of G to C is going to fall, and the alpha is going to fall. That as we grow, the good managers will become very much index-like. The bad managers will become very much index-like, but faster. I mean, if you really are not bad and you get a business that's going to give you an annuity for life and make you very, very comfortable, you're going to quickly try and lock that in. Okay. Now the trick then becomes is how do I run an index fund but look to be active? Because you can't afford to look like an index fund, or people say I'm not going to pay you these high fees to be an index fund. So you've got to actually produce index performance, but still appear to be active, and that can be done. But that's how the game's played. Now if you're good, you get good performance by following your strategy and generating these performances. If you're good and you become big and you become index-like, you throw away your strategy for being good and you just try and run an active appearing index fund. So what we're seeing here, this is an industry where the good people stop using their ability, right? That's an important reason. I'm trying to explain why these people get paid lots of money and don't do anything. We're in an industry where the good people have an incentive to stop using their ability to be good. Using their ability is actually going to reduce the value of their firm.
Yeah.
Okay, because it increases the probability of bad outcomes because of bad luck, and they're going to lose business. They're much better on taking the business they got, locking it in, rather than trying to grow their business any bigger. So that's one reason why we don't get a good performance. By the way, the same incentives don't apply to the bad people. They keep on coming up and playing this game and using their inability. So that's a strange aspect of it. So what we've really looked at here, though, is that these are principal agency problems between a firm and its clients, a funds management firm and its clients. Right? That if I'm really running this firm in the interests of the owners, I will in fact behave in this way. In this way. What is interesting is there was other conflicts. Because there's a funds management firm who has owners, and then there's people who manage the funds, right? Now, if they're not the owners, you have another principal agency problem between the fund managers and the firm itself. Because if I'm a good fund manager, I will grow my fund. The people who own the firm will come and tell me, I want you to stop using your ability to try and outperform, right? I want you to become index-like. Now, that will have two problems for you. Firstly, if your salary is affected by not using your ability to generate profits, you won't like it, right? I mean, if you're paid on performance and they're saying don't perform, then that'll happen. And of course, self-actualisation is a bit of a problem too. You know you're good, but you're not allowed to actually show anybody you're good anymore. That's why people leave big organisations and set up their own small funds management firms, boutiques. Right? Because then they start this game over again. Of course, and if they started as owners, then we don't, and you own the firm and you manage the money, then you don't have the same type of conflict. But there's a lot of principal agency problems, not only between clients and the funds management firms, but within the funds management firms as well. One other thing that's happened in the industry, well, we'll get to that, is it wasn't always that fund managers were compared to benchmarks. When did it start happening? It probably really only started happening, when did I go out? I went out in the late 80s. Probably still in the late 80s, people were managing large pension funds by having lots of balanced managers. Balanced managers were people who invested across all the asset classes, right? And you compared your managers against a peer group of other managers, not against the index. We went to specialist managers, that is people where I use you for equities and you for debt and you for property and all that, and maybe you for the asset allocation across the fund, and introduce what we call manager mandates, probably in the 80s. I wrote the first manager mandate in Australia in about 89. In about 1989, for UniSuper actually, but they weren't common. They weren't common up till then. Now, one thing I want to show you is that benchmarks have not worked to the advantage of the people. It makes sense, right? I mean, you're in this game. The average performance in this is the index. I want you to do better than the index. But that's what the mandates go. That's what the agreements say. That's actually resulted in people being much more conservative in how they manage money. Okay, much more conservative in how they manage money. Now that's somewhat good. I mean, if you've got somebody who's inept managing your money, you want them to not take bets, right? But so it's kind of, it works both ways. But if you've got people who are good, then in fact it produces worse outcomes for the clients. And we can use our model to show that if we use benchmarks in the model, in other words, we compare people on returns relative to the index, or we compare them on their absolute return, we get much more aggressive management if we compare people on absolute return rather than return relative to the index. But that's a perverse effect. I mean, one of the reasons I left consulting, because we were doing all these things, was I thought, well, I'm doing a lot of damage here for these people. Right? No, I don't particularly enjoy it. I can go back to universities and do my stuff. No, it doesn't affect anyone, right? No one takes any notice of it. So
You probably made enough money to be able to do it.
No, I didn't. I left organisations far too early to actually make a lot of money out of it. I did end up with a bit more money than what I had, but most of the money I've made out of the industry has been since I've gone back to university. But, in fact, no, it is. I mean, it's much better in terms. I continued to work for GMO for 5 years after I left them, and that was much better than working for them. They paid me extra money. They gave me all the research assistance I wanted, paid for all the data and everything, let me travel anywhere in the world on their budget. I mean, it was chicken feed to what they did, and that was and I held down this little academic job at this shitty university. This university. I'm sorry. That's what I told the deputy vice chancellor about him when he said, "You'll never get a chair here." I said, "Well, at least I had a chair at a real university, meaning ANU." He went. He absolutely subsequently went, and I did get a chair. Anyway, but the second one here is on the curse of benchmarks, and that's kind of the story I want to go. I'll quickly go through that again. But the fact is that this is an industry where we have an endless supply of agents and a huge amount of uncertainty. So contracts are very, very important, right? And they proliferate, right? You need to have precise contracts that give the right incentives to get any decent type of outcome out of this. And for the funds management industry, what we got out of it was the mandates with these benchmarks against performance. Okay. So we talked about that. Now, when we gave out these benchmarks to people, I mean, the thing that I noticed was that these managers took these benchmarks very seriously. Because we have a thing called tracking error. Normally in the contract it says that you have to achieve this level of outperformance with a tracking error no greater than something. Now, tracking error is just the standard deviation of the excess returns, right? The returns relative to the index. And the tracking error is really going to constrain the bets that these people can take. If I've got a very low tracking error, I just can't take big bets if I'm going to, in fact, stay within them. Okay. But they took them very seriously. In fact, I noticed they took them over seriously. I mean, I used to go to the university's monthly meetings with the managers, and they used to come in and they used to say, "Well, we've done this," and I said, "We're paying you to be active." And they said, we didn't understand. You've given this mandate and you got this tracking error in there, and we thought, we didn't know you wanted to be that active, so but we'll be more active in the future. And they come back 3 months later and they weren't more active, right? Because they didn't want to take bets. That was their business risk. So people not only kept to these mandates, but they actually overreacted to the managers in terms of being more conservative. And that was the effect that the mandates had on the managers. Okay, I want to look at just one aspect of that, and that is, okay, you just think of it. I'm an active manager. I buy stocks. Well, I buy stocks when I set up my portfolio. I buy stocks which I like. Okay. But I've got to be conscious of the tracking area they're introducing, right? So it's, to me, I've got, as you would expect, a risk-return trade-off. But I am constrained. What it means is, I have to put in my stock in my portfolio stocks I don't like, in order to be able to get the tracking area outcome. I mean, it may not be, in Australia, the banks make up 30, or at least a third of the index, and I don't know what they are in the UK. If I hate banks, I've still got to hold a huge amount of banks in my portfolio, or I blow out my tracking error constraints. So, these constraints mean that my preferences in terms of the stocks I like and that are actually shattered a lot by a need to, in fact, maintain a certain level of exposure to keep within tracking error constraints. And that means buying stocks which I think are going to underperform. That's very, very, very common. What it means even more so is that if a stock, just say there's a stock out there which I don't like and I don't hold much of it, and it goes up a lot. I actually dislike it more, but I have to buy a lot of it now because I'll blow my tracking error constraints. So what these benchmarks do is it enforce things like momentum. I've got to jump in late to stocks that are doing well, and it happens in reverse. I might like stocks, but if they do badly, my bet size will go up if the price, and I might have overweighted them, they go down. I've got to actually sell stocks which I like. So what a benchmark does, it distorts the relationship between what I think is a good stock to invest in and a bad stock to invest in, and the actual holdings that I have. Right?
Yeah.
And that's one of the reasons. That's one of the things which distort it. What do funds managers? Fund managers do two things. They try and identify securities which are cheap or mispriced, effectively, stock selection. So they try and say, well, I like these and I don't like these, and I'm going to build a portfolio which reflects that. The second part is portfolio construction, and portfolio construction is determining what weights I give to the various stocks or securities. Now, these benchmarks really distort the relationship between stock selection and actual holdings or the portfolio construction process. Okay.
Just like I tried in the first part to see the analytical driver of what you're saying, I think I can see it here too. Let me try. The first thing you might expect a tracking error requirement to do is just to compress variance with no effect on the mean. But if stock prices are auto-aggressive, then and let's suppose that they don't just jump up and go back like, but there's a kind of, if stock prices do that, then you will be required to buy during that run, and you will be, and that will force you to overpay for that stock. And if you have to do that over and over again, that constraint will depress the mean. And so this compression, of course, would not depress the mean if the stock prices were white noise. It's the combination of this compression when the stock prices are not white noise that, although it contracts variance, actually depresses the mean.
True.
Exactly. I haven't ever seen any of that. That's really interesting.
That's it. That's great. I'm conscious of time. I want to actually go on this, do something useful for you people. I want to. This is not. I want to talk about the efficient market hypothesis for a few minutes, a couple of minutes. Okay. I mean, let me give a very biased view. We have had empirical work, ignoring the work by the mathematicians going back to Bachelet, in 1989 or something. We have heaps of studies of the efficient market hypothesis, right? And my reading of it is we get three insights from that. Firstly, that actually, and you'll be surprised by that, prices underreact to information shocks. Okay. Now, a lot of people will find that hard to believe. I would like to bet my last dollar on that being a true statement, actually. The second thing we see is, and this gets back, David said, prices tend to trend in both directions. Okay. And the third thing is that prices overshoot fair value in both suggestions. In fact, if if that was fair value, then effectively what I'm talking about is you get oscillations around fair value where stocks become cheap, trend down to becoming cheap, trend up to becoming expensive, and behave something like that. Okay. Now, This is a Mendham life cycle from an article by Lee and Swaminathan about 2000, was it? Yeah, 2000. Which I think captures everything very, very nicely in terms of, as I say, I'm not saying, maybe not like to you, but if you want to know anything about investing, it's all in this one. It's all in this one thing. So let me explain. Let's peek into the cycle at the bottom. Let's say a stock that's coming down towards the bottom there, in fact, well into phase 2. And what it has been, it's been giving out lots of bad information signals. Bad information signals, remember, are bad relative to expectations. the price of a stock really reflects two things: the risks attached to the earnings of that stock and the expected growth. So high price means there's high growth expectations, low prices, low growth expectations, and that. So here's a stock that's been doing badly for a long period of time. What's happened to that stock? Well, what's happened to that stock is that the market has lost interest. You will find low turnover, very few analysts managing it. It will be cheap. It will be what's called a value stock. Its price will be, in fact, it would have downward momentum and all those types of characteristics. But the second of this is low price. Low price means expected low growth, earnings growth. I mean, this stock, by the way, is going in one of two things. It's either going to go out backwards, it's eventually going to be taken over or go into liquidation or something, right? It's on that trend. Or, and quite commonly, it will come out with some news which is better than what was expected. Not good news, but better than what was expected. Now, what happens when it comes out with news which is better than what expected? Let's assume there are three types of investors out there, fundamental investors. They're the ones who used to control the market. They're the people who evaluate all the information, come up with some idea of prices. Let me say, in the market today, in equity markets, they represent about less than a third of the people playing markets in terms of cash in money there. Probably more like a quarter. These are the actual. So they will look at this and say, well, this is interesting. Okay, I mean, the stock has produced some news which is a bit better than what expected. But then we have the index funds. Nothing to me. I mean, this news. We have the momentum investors who are still selling the stock because it's on the downward trend. So we don't. The thing is that the stock market's a bit like an aircraft carrier. Right? I'm going to turn it around, but I'm going to turn it now. If I want it to turn 20 miles down there, I'll start turning it now. That stock will continue to fall, or at best maintain its price. But expectations will be the same. If the fundamentals are picked up a bit, it will come out with some more good news. Yeah. Again, it will have very little effect on in terms of sucking people into the market. But which means that you get information trends, and you do. You get good news is highly correlated. A good news signal is more likely to be followed by another good news signal or another good news signal, etc., and bad news signals. So, because the supply and demand, you need to have you reach a stage when you have enough good news signals that the momentum that the fundamental people are willing to trade at sufficient volume to offset the momentum people, etc., to start turning the price around. And but this is why we get trends, because we get underreactions to information. We get more good news. We get reaction to that, more good news. We get more good news, underreaction to that. But you start turning it around to the trend going in the opposite direction. To when the momentum people come in and start buying, right? So then you reach a stage where both people are going in the same direction, the momentum and the fundamental people, and you start going up through phase 3 to phase 4 because you don't stop at fair value. You don't stop at fair value. Because there's the momentum people still driving, even though the fundamental people might say we're at fair value. There's still the momentum people putting in demand into the market to drive it beyond that. And then, of course, you get to the top. The expectations are so high. The realities, you can't actually meet the expectations, and you have this slow turnaround in the opposite direction. Now, you say, well, people, not all stocks behave like that, oscillate around fair value, and that's true. But a lot do, and sufficient do to follow. So
excuse us for going on so long. But bye.
So that is. But let's look at that cycle and say who's going to buy at what stage. Going back to my previous point, the first people to buy will be the fundamental investors, right? When we get a change, a turnaround, you will then get momentum investors coming along. But who are the bunnies at the end? The bunnies at the end are people driven by the tracking error constraints, who have to buy in because the price has gone up a lot. They're just price takers. Doesn't matter what the price is, they've got to actually buy into these things. And so they're the people everybody profits on. Now, if you look back through history, who are the people who actually do the best out of this? The best performance, and I know we can go back to the financial crisis and a very much underperformance of momentum people, but over periods of time, the momentum investors actually get the highest return. They do get some very bad at turning points, and very serious turning points, like the GFC. They do suffer, but over the price band, they get it, because the problem with the fundamental people is they tend to buy in too early. If the fundamental people buy when they think it's cheap, that's stupid. That's like being a hero, right? I think the market's wrong. All these other people are going to continue to trade against me, but I'm going to buy in anyway. If you're a fundamental investor, you can't afford to trade when your signal says it's cheap. You've got to wait to when the market sentiment starts to change. So if I really follow a fundamental approach, I'm not going to get a good outcome. The best way of playing the markets is to wait to when the market has actually signalled a change in direction and then come in, which effectively is what the momentum people do. I mean, it's frightening, because it says buy stocks that have been going up and sell stocks that are going down, and really you don't need to have to go to university for many years to actually be able to implement that strategy. My 8-year-old could implement that strategy, but there are much more complicated things than that. But the general philosophy behind that momentum cycle, in fact, is a fantastic way of driving investment strategies.
We ought to finish in about 5 minutes.
Well, I got one more study I want to talk about. One thing is said, well, if active management can't do it, let's go to index funds. Well, of course, index funds are even worse, right? If I'm an index fund, then in fact it doesn't overcome any of the problems, exacerbate it. I have lots of arguments with Bogle over index funds. I mean, we've suggested that index funds should come with a warning such as cigarettes. Index funds are bad for the economy, because they are, right? They break down the pricing process, and in fact lead to lots of mispricing in markets and misallocations of capital, etc., because they don't bring information into markets. All the information is completely irrelevant to their strategy. So that's another. This other one is okay. Now, diversification. I should say at the beginning, I left I actually, when you say, Dave, at the beginning, I did my financial first course in 1966, which in Van Horn was the first year in Australia that the first text based upon the capital asset pricing model was available, right? So I was kind of fortunate about it. But I left believing three things. I believe the capital asset pricing model, not worth the paper it's written on, as an empirical explanation of anything. Efficient markets, rubbish. But at least I thought, and I got to know him quite well, the market which on diversification was right, and it's built into law, right? I mean, it's the prudent man, diversification, pension funds have to diversify and everything, and at least I believe, well, that's true. It took me a long time to realise that that's rubbish too. Not because Markowitz is wrong, but in terms of how we interpret it. But let's look at what a few people say about diversification. I mean, I'm sure a lot of you know what Keynes said about diversification. Okay. What Buffett says, diversification is protection against ignorance. And then Charlie Munger, who's 2IC, right, really probably the brains behind Buffett, saying that academics have done a terrible disservice to intelligent investors by glorifying the idea of diversification. There's some. I in fact think Charlie's pretty right actually on that. We've sent out people. One of the reasons we freed up capital markets because we believe that they solve their own problems, right? And they don't solve their own problems. Sending out people who believe in things like efficient markets and things, I think we've done a huge disservice for the world. But anyway,
don't go till we read the bottom.
Okay.
It's just that, yeah. Sorry.
So what I wanted to do was look at see, diversification is right if assets are efficiently priced, right? because if I expand my portfolio, I reduce risk. If the expected return is 0, then I don't give up any return, I reduce risk, and therefore if assets are mispriced, then diversification becomes quite a different issue. I don't want to diversify by putting overpriced stocks into my portfolio. Okay. But we've seen that tracking error things in right forward me. As I had numbers up there before, but tracking error forces me to hold bigger and bigger portfolios. Okay, and trustees are forced to hold them because if they're going to be fiduciaries, the law forces them to hold them. Says that if you're going to actually get bad performance and the members of your fund can show you didn't diversify, then you're going to be, at least in some countries like in Australia with the corporate trustees, you're going to be personally at risk. Everybody's interest to hold diversified portfolios, even if they don't make any sense. But let's have a look at one thing. What we did was we ranked stocks in terms of how much managers like them, right? By looking at their bet size. We said, well, the bigger the bet, the more they like a stock. And we ranked their portfolios from 1 down to whatever. And then we said, what would be the performance of the portfolios if they only invested in their best 5 bets? Best 10 bets, best 15 bets, best 20 bets. And we got this as the answer. Now, I don't know if that's... looking at the incrementally, just look at the left-hand side. Because the first line there is the top 5 bets. Then the next 5. Then the next 5. And if you go to the other side, you get the returns after transactions cost of that. So you see it goes from 12.75 to 9.85, to 9.26, 8%, 7%. Now, what would they do in an index fund? After fees, they do 8.94. So you can see that after they get much beyond 15 stocks, then they're adding stocks to their portfolio and reducing their performance. Oh, okay. Now, what is the average size of the fund? US equity fund was 87 stocks, right? By the time they get down to 87, they're well gone beyond any of the ones they can add value, right? And so, not surprisingly, if you look at the performance of their portfolios, they don't seem to have any skills. They have got skills. They spend all their time trying to identify cheap stocks. That's what a typical manager does. That's about 90% of their time, and they can identify some. But they're forced to give any of that away by diluting them by, in fact, having to hold diversified type portfolios. Okay? Now, what we typically do is invest in a small number of managers who diversify for us, right? Alternatively would be to invest in a lot of managers who have concentrated portfolios and to get a diversified portfolio by the aggregation. Okay. And this is the kind of results you get. Now, it's not stellar, because if I invest in the top 5 bets, you see I'll get 12.92. If I just invest in a manager who any one fund, that's randomly choosing any one fund. These are random choices of managers and taking their top 5 as against taking their whole portfolio, it's 10.82. If I invest in their top 15, it's 11.19 back to 10.82. I mean, I have to have very concentrated portfolios of managers to get much out of this, right? Because by the time I go to the top 15, there's not a lot there. It's only about 0.38% or so, 0.37%, and a Sharpe ratio goes up marginally. However, this is randomly choosing managers, right? If you think back to what Buffett said, and what in particular, you don't want to use concentrated portfolio. You don't want to get concentrated portfolios from the average manager. That's what they do. Right? They haven't got any skills. So this is looking at skills. This is the whole sample where we're getting the average manager, just randomly choosing from the top 75 versus top 50, the top 10% of managers. And you can see by the time you get the top 10% managers, their top 5 stocks do 18.6, which is over double what the index does. And that's kind of getting to Buffett. If you're good, you don't want to diversify. if you're bad, you do want to diversify because that's the only way as a manager you'll manage your business risk. Okay. But diversification, I mean, we sing the praise of diversification. Diversification is good if prices are efficient. If prices aren't efficient, then that breaks down. Now, if you put a number of things together here, why don't managers show that they're any good? Well, they don't show that they're any good for several reasons. A, their business imperatives are to not use their skill once they grow their business. B, they actually are forced to diversify, which means diluting any skill that they might have and giving it back. There's lots of reasons why when you look across managers you don't find that they're any good at what they do. They may have inherent skills. They typically do have some ability to identify mispriced stocks, but the client will never see it because of the way the game's played.
That's a good place to end, isn't it?